Today I want to talk about hindsight bias. Hindsight bias occurs when people see past events as having been predictable or even reasonable to expect. People tend to remember their own predictions of the future as more accurate than they actually were because they are biased by the knowledge of what has actually happened. I hear this all the time after a market decline or an advance. People will say, "I knew that was going to happen. See, I told you so." However, this view is often caused by the reconstructive nature of memory. When people look back, they don't have perfect memory and they tend to fill the gap with what they prefer to believe. Unfortunately, in doing so, investors often prevent themselves from learning from past mistakes. As a result of hindsight bias, they often overestimate the degree to which they actually did predict an investment outcome, thus giving themselves a false sense of confidence. For example, when an investment appreciates for unforeseen reasons, investors may rewrite their own memories to reflect those reasons. The hindsight bias may cause them to take on excessive risk, leading to future investment mistakes. This is a perfect example from 2000 tech bubble. People at first were cautious because it was internet and unproven, but then as the stock started to work, they were saying, "Oh, it's the internet and it's page views and it's that sort of thing," and they rewrote the history of why stocks should be going up, and they ended up making that very investment mistake we were just referring to. Hindsight biases may also cause investors to unfairly assess money managers or security performance. Based on their ability to look back at what took place in the markets, performance is then often compared against what happened as opposed to what they thought was going to happen or what was expected. For example, a given money manager may have followed his or her strategy faithfully and possibly even ranked near the top of their relevant peer group, but the investment results may be disappointing compared to another segment of the market or the market as a whole. We've seen this recently as the U.S. market has outperformed international stocks for a few years in a row, and commodity stocks recently have been hammered on falling oil prices. So clients are asking me about their performance relative to the S&P 500. Well, the S&P 500 is a large company index and is the best performing part of the U.S. market. So of course, everything else pales in comparison to the S&P 500. But that does not mean you want to own just that part of the market.